All right, everybody, ready to jump into the exciting world of intraday trading?
Always ready for a deep dive.
Today, we're taking a page from the Inner Circle Trader, and you know what I love about their style?
Let me guess, their focus on practical setups.
Exactly. And they don't just talk theory, they show you exactly how they trade. We're dissecting their S&P and Nasdaq futures strategy from January 2022.
Ah, yes, using real examples to break things down, always a good sign.
Absolutely. So first thing that struck me, this trader starts hunting for setups right at the market open, 8:30 a.m. sharp. Why is that time so critical in your experience?
Well, think of it like this. 8:30 a.m. Eastern Time, that's when the New York Stock Exchange wakes up,
Mhm.
right? And just like us, it might need a minute to shake off the sleepiness.
So you're saying that's when the markets are most unpredictable.
Exactly. You've got traders reacting to overnight news, economic data dumps. It's all a bit of a whirlwind. If you're looking for those quick intraday moves, that's when the party starts.
Makes sense, catch the wave early. Okay, so this trader's strategy, it's built around range, imbalance, and the magic 50%. Sounds almost mystical, doesn't it?
It's got a certain ring to it, but trust me, it's rooted in solid market principles.
Okay, walk us through it. What's the core concept here?
So range, that's simply the highest and lowest price points of an asset within a certain time frame. Easy peasy.
Gotcha, like the playing field for that particular stock or future.
Exactly. Now the magic 50%, that refers to the midpoint of this range.
All right, keeping up so far. But where does the imbalance part come into play?
Now it gets interesting. This trader believes that when the price swims too far from this midpoint, especially if it dips below, it creates an imbalance.
Imbalance meaning it's due for a correction.
You got it. Think of it like a pendulum. It can swing one way, but it always wants to settle back in the middle.
Okay, so they're looking for those moments when the market's enthusiasm might be a little ahead of itself.
Precisely. And to pinpoint these potential snapback zones, they use a tool you might have heard of, Fibonacci retracement levels.
Fibonacci, now those always sounded a little intimidating to me, like some secret trading code.
I get it, it's got a fancy name, but the idea is actually pretty simple. Remember that price range, the high and the low we talked about? Fibonacci levels, they just divide that range into segments using these specific ratios?
So it's not about predicting the future with magic numbers.
Not at all. Think of these Fibonacci levels like potential pit stops for the price, places where it might hesitate, reverse, or take a breather.
Okay, so it's more about understanding those common areas where the price might change direction.
Exactly. It gives traders like the inner circle trader an edge in deciding when to jump in and out of trades.
All right, so we've got our range, our 50% midpoint, and these Fibonacci levels. Let's see how this plays out in the real world.
That's the exciting part. And the episode gives us two solid examples, one with the S&P and another with the Nasdaq.
Perfect, because seeing it in action is what really brings it home. So let's start with that S&P trade, January 26, 2022. What caught your eye there?
Well, the trader highlights this clear break below the equilibrium point, that 50% mark. Then there's this exciting rally back up, what they call a fair value gap.
Fair value gap. Now that sounds interesting. Break that down for us.
Imagine this. The price plummets. Then suddenly, buyers flood in, pushing it back up super fast. That's the fair value gap forming.
Almost like the market overcorrecting itself.
Exactly. And that's where opportunity knocks.
So the trader sees this price rocketing back up, potentially growing too far too fast, and that's their cue.
Bingo. They recognize this overzealous move and think, time to short. They're essentially betting that the price will naturally gravitate back towards that more balanced level.
It's like they're anticipating the rubber band snapping back.
And what's really cool is the inner circle trader doesn't just tell you about it, they show you on the charts step by step. You're practically looking over their shoulder as they trade.
You're right, it's like getting a sneak peek into their decision-making process. Now let's move on to the Nasdaq trade, the next day, January 27th. What struck me here was that it wasn't just a repeat of the S&P setup.
Ah, you noticed that. See, that's what I appreciate about the inner circle trader. They emphasize adaptability.
It's not about blindly following a formula, right? It's about understanding the why behind the strategy. So what stood out to you about this Nasdaq trade specifically?
This trader, they're big on confirmation, not just jumping the gun. Even though they saw the price dip below that 50% Fibonacci level, they waited for a specific sign.
They waited. So it wasn't an instant trigger. What were they looking for?
Market structure shift, that was their term. And honestly, it's a game changer.
You know, I hear that phrase thrown around a lot, market structure shift. But what's the practical takeaway? Like, how do we actually spot this mythical beast?
Think of it this way. Every market has its rhythm, right? It's like a dance floor. Sometimes it's a slow waltz. Other times it's a mosh pit.
Love the analogy.
So a market structure shift, it's like the music changing abruptly. Suddenly, the old steps don't work. You got to adapt.
So in this NASDAQ trade, what was the big shift, the tempo change?
They were watching this key price level, a previous swing low. As long as the price bounced above that, it was still in that old rhythm. But the moment it broke below, decisively, that's when the inner circle trader knew the game was on.
It's like the market was giving subtle hints. Then bam, a clear signal.
Exactly. And they waited for that confirmation before making their move. That's discipline, not just chasing every little wiggle.
That's a tough one to master. Patience in the heat of the moment.
Tell me about it. But it can save you from some nasty losses. Sometimes the best trade is the one you don't take, you know?
Words to live by. Now, one thing this trader repeated really stuck with me. Study this, not me. It's almost like they're saying, don't be a copycat.
And it's brilliant advice. Because markets change constantly, what works today might not work tomorrow.
So blindly copying someone else, it's like trying to fit a square peg in a round hole. It's just not going to work long term.
You got it. The inner circle trader understands that. They want you to learn the process, the thinking behind it, so you can adapt. It's about empowerment, not dependency.
Become your own trading guru. I like that. So we've covered specific strategies, but what about the bigger picture? What are some common misconceptions about intraday trading that you'd like to debunk?
Oh, where do I even begin? The biggest one. It's not a get-rich-quick scheme.
Right, like it's some magical money tree that you just shake and profits fall out.
If only. Intraday trading. It takes skill, strategy, risk management, and yeah, a good dose of emotional resilience.
So, not for the faint of heart.
It's more about consistent effort over time, not overnight riches.
Another myth I hear is you have to be glued to your screen 24/7 to make it work.
Yeah, that's a recipe for burnout, not success. Intraday trading does require attention, but it's not about chasing every tick.
So it's possible to find a balance, to be an active trader without letting it consume your whole life.
Absolutely. With the right approach, you can incorporate it into your existing routine. No need for a Wall Street bunker.
That's good to hear. Because honestly, I always picture those traders with 5 monitors yelling into headsets.
Lives. Hollywood loves to exaggerate.
So we've busted the get-rich-quick myth, the always-on myth. And what about the idea that it's only for seasoned pros, the Wall Street wolves?
That's a big one. While experience helps, don't let it be a barrier to entry. We've got tons of resources now, online courses, demo accounts. You can learn and practice without risking your life savings.
So it's more about having the right mindset, the willingness to learn and put in the work than any specific background.
100%. And the beauty is the learning never stops. Markets are always changing. There's always something new to discover.
It's true, the markets never sleep, do they? But speaking of starting out, for our listeners who are ready to take that first step into intraday trading, where's a good place to begin? What's step one?
Well, it's like building a house, right? You don't start with a roof. You got to lay a strong foundation first.
And in trading, that foundation is
Knowledge, my friend. Education is key.
so hit the books before hitting the buy button.
Exactly. Understand the basics, technical analysis, risk management, different trading strategies. There's a wealth of information out there, both online and offline.
What about finding a mentor or maybe joining a trading community? I imagine having that support system could be invaluable, especially for someone new to all this.
Absolutely. Having a group of experienced traders to learn from, to bounce ideas off of, to share the wins and losses with, it's huge. It's like having a gym buddy, keeps you motivated, accountable.
I like that, a trading buddy system.
Right. And even just observing how more seasoned traders approach the market can be incredibly insightful.
Soak it all in. So we've got education, mentorship, and then, of course, the hands-on part.
Practice, practice, practice. And luckily, we've got these amazing tools now, demo accounts, simulated trading platforms. It's like training wheels for traders.
You can test out your skills without risking real money.
Exactly. Get comfortable with the platform, try different strategies, see what happens. Most importantly, get used to managing your emotions when things get heated. Because trust me, they will.
Right, because we've talked about the importance of emotional control, not letting fear or greed run the show. Easier said than done sometimes, though.
No doubt. But that's why that practice is so important. It's like training for a marathon. You don't just show up and run 26 miles. You build up your mental and emotional stamina over time.
So it's all about developing that trader's mindset, right? That ability to stay calm and rational even when the market is throwing a curveball.
Exactly. You're not going to eliminate emotions entirely. That's impossible.
Yeah.
But you can learn to manage them, to not let them control your decisions.
This has been such an insightful conversation, really eye-opening. We've gone from dissecting the inner circle trader's strategies to exploring these broader concepts of market structure, risk management, and the mental game of trading.
It's all connected, isn't it? It's not just about the charts. It's about understanding the psychology behind the markets and even your own psychology as a trader.
Absolutely. So for everyone listening who's feeling inspired to dive headfirst into intraday trading, what are some key takeaways they should keep in mind?
First and foremost, knowledge is power. Educate yourself, never stop learning. Second, find a community, a mentor, a trading buddy. Having that support makes all the difference. And lastly, practice, practice, practice.
And don't be afraid to make mistakes, because that's how we learn and grow.
Exactly. Embrace the journey, the ups and downs.
On that note, we'll wrap up this incredible deep dive into the thrilling world of intraday trading. Until next time, happy trading, everyone.